Hi, everyone. Welcome to our final Park at Arlington investment webinar. I wanted to do things a little different this time around, and I have had over 150 investor calls. At least that's when maybe I stopped counting. But I wanted to use that opportunity to answer any last minute burning questions that you might have. Also, my team has collated a bunch of questions from, again, all the investor calls through social media, kind of pulled together the top questions that we keep getting asked over and over about the deal. And I wanted to bring all of that to answer that today. I have a few points about the deal. And then the goal is to delve into the questions. The full investment deck is available on the portal. So my goal today is just kind of run you through some high level points. And then after that, go into question and answer. If you have any additional questions outside of the questions that we have collected over the past few months, please drop them in the chat and I'll kind of repeat that if you are late or if you're joining a little bit late. I know around this time people are wrapping up work, so I'll just make that reminder again. If you have questions, I said, drop them in the chat, but also at the end, feel free to unmute yourself and we can ask the questions or you can ask them out loud. So I will always want to just say this, right? This is important. As accomplished professionals, you understand the true value of like doing due diligence in anything, right? So this is no different. So what I'm sharing with you today about this deal is really just for you, right? I want us to have opportunities like this, but I do encourage you to reach out to your trusted advisors and ask questions. And then if you have any further questions, please bring it to me. Okay, so let's jump into the Park at Arlington. Park at Arlington, it's 188 units. It's garden style community. It was built in 2001. Right now, it's 94% occupied. And what a lot of things that we love about this property is that it is in a solid, growing market and it's already performing well. And our goal is just to make sure that it's performing a lot better. And so for the investors who are excited to jump on the call, who are on the call and ready to jump, who are excited to jump into this opportunity. I know you've heard about it. You've seen emails. We've had investor calls about it. Our team is going to put a link in the portal, right? Just feel free to click on it, sign up, create an account, and you'll see you have access to the Park at Arlington deal. We will then go ahead and get in touch with you, get in contact with you, and then we'll be able to kind of walk you through the next steps. You have access to all the deal deck, the operating agreement, the private placement memorandum, all of that is available in the portal. So feel free to go there. And again, the link is going to be in the chat right now. And this, I also want to make sure that you know that this opportunity is open to only accredited investors. So just a little detail about the deal. We're purchasing it for 33 million. And the best part about it is that we are buying it with an assumable loan, and the loan is fixed. It's at 3.5%. And for all those who didn't hear me well, I did say 3.5%. Right now, for brand new debt that you originate today, it looks more like 6 to 7%, right? So this is a wonderful opportunity, but this also means that it's better cash flow for us from day one. We're protected. We are protected if the rates go up because again, it's fixed, right? What that means, it really translates to stronger returns for you as an investor. And I want to just spend a little bit of time saying why I think this deal kind of gets me excited, why a lot of our investors have already jumped into it, right? I've seen a lot of deals. We as a team have reviewed a lot of deals and we've passed on a lot of them. But the Park at Arlington is a little different, right? The property is not distressed. It's 94% occupied right now. And our goal is to even, try and increase that occupancy by another like percent or two. But the truth is that people want to live there. And if we think about the market, right, Georgia, Covington, Georgia specifically, right, Rivian is building a massive EV, so electric vehicle, and they're breaking ground sometime this year. But in addition to that, right, Facebook's Meta, they have a data center that is already operational right now in Covington. What that translates to is truly like billions of dollars in investments that are being created, and with that comes jobs. And again, these jobs need people to fill them, and the people need a place to live. And that's where we come in. So one of the things that we're constantly thinking about when we're looking for opportunities is what type of market, like where exactly is it? What's happening in that market? We want to make sure that jobs are there, population is growing. That's really important because that feeds into thinking about how the rents are going to grow, how the property is going to do long term. So, real quickly, and then we'll delve into questions. There are two classes, two different tiers of investment classes in the deal, and that's Class A and Class B. And this question comes up a lot, and I actually think it's also in one of our Q&A questions, but the difference between these two classes. And when I think about a Class A investor, right, they are a little bit more risk averse, right? They want cash flow today. So they prioritize cash flow earlier on in the deal. And then they don't participate in any profit share or appreciation that happens at the back end of the deal when we sell. So those are kind of the big differences. And they are looking at a 10% average annual return on their investment. Class B is a little bit different, right? They really want more of the upside in the deal. So their investment, comes from both cash flow and appreciation, or think about it as profit share, right? So it's a combination of those two. The cash flow is as the deal is operating, and then the profit share is at time of sale and when the deal ends. So that's kind of a combination of where the growth on the deal is coming from for Class B investors. And that looks like for Park at Arlington, that looks more like 17, a little bit under 17.5% average annual return. So that means what you're getting yearly on your investment. So a lot of this, I get this question asked a lot, and it's about taxes, right? So another major benefit of this deal is depreciation. And our initial kind of based on our preliminary estimates from, our cost segregation team and our accountant, we are projecting about $45,000 in depreciation for every $100,000 that you invest, right? And so if you invested, let's say 50,000, it would be kind of half of that. But what does that mean in simple terms, right? So again, if you invested $100,000 today in the Park at Arlington deal, right, you could receive roughly around $45,000 in paper losses that will be allocated to you, which means that it can help you reduce your taxable income. Now, this is not cash back, right? So I'm not giving you cash. I want you to think about it as a tax deduction. So the best way to think about it is the actual savings that you're getting, actual paper losses that you're getting on the investment that you did. And now the actual savings is going to depend on your personal tax bracket. So that just depends. And at the end of every year, right, during tax season, the beginning of next year, you're going to get a K-1, and that will have your depreciation, and you can give that to your accountant or whoever is filing your taxes. But the final numbers, right? This is just an estimate right now. The final numbers will be confirmed after we close. But I just want to give you a strong idea on the benefit or the tax efficiency that's really built into this deal. And I think that that's important as you think about the benefits. Okay, so kind of again, I said high level so we can jump into questions. In the portal, you're going to again be able to review the deal. Right. So the first thing we're going to do is kind of click on the link. It should be in the chat. Click on the link, sign up, and then at that point, right, we will know you're in the portal. We will then follow up with you in the next coming days and kind of walk you through the whole process. But in the portal, again, you're going to be able to review the deal. You're going to kind of understand, deep dive into all things about the deal, and then a team member will be able to meet with you and then walk you through the whole process. So kind of hold your hand as you walk through the whole portal and understanding the deal, reviewing the deal deck, the operating agreement, the subscription documents, all of that you have access to. And after you fill out all the documents, sign it, the last step is wiring. So that's what the process after kind of making a decision. If at any point you have any questions, if at any point you're confused, you want to, please feel free to reach out to one of us. Any team member can kind of walk you through the whole process, answer any questions, and kind of help you finish it out. So just know that that is available and accessible to you. I get this question asked a lot, and I want to mention it. And I think that's one of the questions also in our Q&A, but how can you invest, right? What are the options you have? So you can invest, the simple terms are kind of investing with cash, and all that information, again, is on the portal when you click on the link and you get in, but you can also invest through a self-directed IRA. So the idea is to use an old 401k or some sort of IRA, and you're going to convert that into a self-directed IRA. You have to use a custodian to do this. And we have custodians that can walk you, kind of walk you through the whole process. But the idea is that you have multiple ways to be able to invest in opportunities like this. And I think the thing that's stopping us is sometimes we just don't know and we don't have access. And so that's why I'm talking about it. Okay, time for questions. And again, these are the questions that have been asked to us multiple times. And so we just wanted to bring it up and I was going to answer it. And if you have any additional questions, again, please feel free to toss it in the chat. So first question, what happens to returns if the rent grows slower than projected? And this is a really good question, right? If rents grow slower than we expect, right? This is a truth. Returns can go down, but they're not going to completely disappear. One of the things we do is that we underwrite very conservatively, meaning that we don't make very aggressive like rent growth projections. So we're not saying that rent is going to grow by like 10, 12, 15%, right? We say it's probably going to grow 1%, 2%, maybe 3%, but that's how conservative we underwrite. Now, if rent does grow slower, right? What is going to happen? Cash flow might go down, the exit value might be lower. So those are things that we think about, right? But I want you to know that the property is still going to be producing income, and I think that's really important. So that is why the big focus in when we're buying is that we're buying right and we're also improving the operation. So we're going in and thinking about how can we make this property operate more efficiently so that, you know, our investors benefit. So that's when we think about how the returns work, right? So we don't just want to focus on market appreciation, which is where rent growth comes in. We're really looking at it from a kind of bigger perspective. Next question is, how will NOI increase? Your first question should be, what is NOI, right? And NOI is just net operating income, and it's simply the income that comes into the property. So think about through rent and then expenses. So it's income minus expenses. That is your net. That's your NOI. So your net operating income. And there are two ways in which we can increase NOI. And if you think about that formula, right, you can either increase income or you can decrease expenses. So when I think about increasing income, you know, the thing that we do is we go in and we renovate. So we renovate units, we upgrade the interior, and that way, that's a way for us to increase the income that's coming into the property. We might also consider adding like a small tech package. Another thing we would do is like really think about focusing on reducing vacancy, because if we reduce vacancy, that means our occupancy is high. That means more income is coming in. So those are just some of the ways we think about increasing income. And then in terms of expenses, right, we want to decrease expenses. So we really want to reduce any unnecessary expenses. So we're really looking at every line item from an expense standpoint and thinking, what do we need to shave off? You could also think about renegotiating vendor contracts, anything that would make the property operate better from an expense standpoint, right? We think about that. But I want you to understand that very small improvements in the NOI can significantly increase the value of the property. So that's why this is very important. So that was a really good question. Another question is, what are the biggest risk factors in the deal? I get asked this all the time. And I just want to say this so that you hear from me, right? Every real estate deal has risks, right? And nothing is without risk. If any operator is telling you that like this deal is risk-free, you should run away. But some of the biggest ones that I can think about when I think about like maybe, you know, even if it's this deal or other deals or just kind of deals in the market. But we talked about the first one, which is that the rent growth can be slower than expected. So maybe we think the market is going to do really well, even with Rivian coming in and Meta and all these things, right? Maybe rent doesn't grow as fast as we think. So that's one. Another risk is like vacancy, right? For some reason, vacancy might be increasing. That's another risk in the deal. Another risk is maybe unexpected, like if we have these unexpected expenses that maybe we did not budget for, right? We have to think about that. And then interest rate, like, so if interest rate shifts, right? For us, while we're holding the deal, it doesn't really matter because we buy fixed, right? We buy fixed debt. But like if we were refinancing and interest rates shift, right? That could be a risk that we have to think about taking on. And then if you think about just like there's a risk in when to exit, right? Like if we plan, our goal for this deal is to hold it for 5 years. If at that time maybe the market isn't great, right? That might be a risk that we might have to understand and figure out really how to tackle. But again, right, when we think about these risks, we really manage them. I say this over and over, but it's very important and it's true that we have very conservative underwriting. We also have strong reserves. That means that we have money in the bank, liquid cash for, just for rainy day expenses. So something that we didn't budget, that we didn't expect. Now we think about worst case scenarios, but there are things that we could never ever predict, right? And so we make sure that we have strong reserves for that. And then another thing is like how some of these risks can be mitigated with just like operating, from a level of expertise. So that means like, our asset management team is 10 out of 10. I can say that very proudly. And so we're always thinking, we have operated multiple deals over years. And so there's a lot of mistakes that have happened that we've learned from them, we've grown from them, all of that, we bring that into this deal. And also like an experienced property management team, a team that is like willing to understand our vision, our big picture. I think that really helps in mitigating some of these risks. Okay, so what happens if you don't sell the property at year 5? I get this asked all the time, right? So year 5 is the target, right? But we're not going to force the sale. If the market conditions are not great or they're not where we are, like let's just say another COVID happens. We all hope it doesn't happen, right? But if just the conditions are not ideal for us to sell right there and then, we can hold it longer, right? As long as the deal's continuing to cash flow, that's a good thing. That's a positive, right? So we could hold it a little bit longer and then sell when the market improves. So we have options, right? That year 5 is truly a target. It's what we would like to it would be a good place for us to like complete our business plan based on, our underwriting, based on our projections. But if we don't sell, your ownership is still intact. The timeline is just going to extend, but like your investment is going to continue to work and you're going to keep getting distributions. None of that changes. Another question I have is, is there flexibility if like unexpected expenses happen? And the answer is yes. We always build in like capital reserves, operational reserves. We have really solid insurance. So we have like really good insurance coverage. All of that is kind of us thinking, what if something unexpected happens? So like unexpected could be like fire, storm damage, like, in the southeast with the storm, I can't remember her name, that came a few weeks ago, right? That would have caused some damage. And that was one of like the worst winter storms in 10 years, I think, to some states. And so that's something that maybe we didn't plan for, but like we have flexibility for that. So just that's how to think about that. And again, right, maintaining liquidity so that we can handle any of these surprises are very important. Under what situation would a capital call be made? I just got asked this last week. An investor sent me an email and I responded to her. And I just said, capital calls are rare, but they can happen. Fortunately, none of our deals have undergone a capital call, but it could happen. So it would happen if there's like some major unforeseen event that exceeds all the reserves that we have, right? If that happens, we will reach back out and ask for some more capital to be injected into the deal. If for some reason, maybe like at refinance, right? If we hold the deal for 5 years and we need to refinance, right? And we need some additional equity, we could reach back out for that purpose. And then if the deal has just been underperforming for a really, really long time, that we don't even have enough cash flow to pay our debt, right? That is a reason for a capital call. Again, going in, right, we structure the deal to avoid needing a capital call. It really is a last resort. But I want to be able to answer these questions, right, so that you know that we are thinking about it in case something happens and we have it covered. But that's the reason why, I like some of these questions. They're hard, but I think they're very warranted, again, because this is your hard-earned income and you want to make sure that it's invested in the right opportunity. What proportion of investors are Class A versus Class B? Good question. And I talked about that kind of earlier. I talked about kind of the difference between the classes, but again, Class A is just a little bit lower risk. They get paid first, but then it's lower upside, right? They are not making as much in the deal and they're not making anything from profit share. And then Class B, again, is slightly riskier because they're participating in the upside and in the profits. But both classes, they benefit from the same asset. They're obviously in the same deal. The structure is just differently. So in our deals, we set aside about 10% of the equity raise. So how much we need to close for Class A investors. And that really looks like not more than 5% of investors really invest in Class A. A lot of investors are okay. They have a long-term perspective, long-term mindset, and would like to make more money on the back end. What does it mean to be an accredited investor? And I mentioned it earlier and I forgot to explain it. So I'm glad this question came up. But an accredited investor is someone who meets, either the income threshold or the net worth threshold to be able to invest in these deals. And these deals are like it's a this classification, accredited investor, is a regulatory classification by the SEC, and it's something that we have to abide by. And so that means that as an accredited investor, you have to have $200,000 or more in income if you're single. So you have to be making that much, and you have to have made that for the last 2 years, or $300,000 in income if you are married. So that's between you and your spouse, or you have to have $1 million in net worth that does not include your primary residence. So it's not all three of them, it's any of them. So if you meet any of those, then you qualify to be an accredited investor and you can invest in the deal. What happens if occupancy drops? I think we talked about that a little bit, but if occupancy drops, right, rental income drops. That's expected because our income comes from occupancy. But if that happens, cash flow is going to drop and distributions may decrease temporarily. So that's just something to think about. But again, right, we stress test the deal with a lot of vacancy scenarios. And I will tell you that, right, when we start underwriting the property, right, we increase vacancy just to be a little bit more conservative. So like this property is 94% occupied, right? In underwriting, sometimes we will add, maybe an additional like 3-4% in vacancy just to make sure that like what happens if that happens to the deal. So we never assume 100% occupancy. We actually increase vacancy as we stress test the deal at year 0 and then thinking about how to make it better in the next 5 years. Is there a chance that you can sell early? Yes. If the market does spectacular and we get a very strong offer to sell early, or a very strong offer to buy, we will sell. So, and it's something that we make a decision as the operation group, right? We make a decision and we decide to sell, and we're going to let you guys know as investors. But all that means is that you're going to receive your profits sooner. And when we sell early, right, it can actually increase your annualized return. So you end up maybe making more in the deal. But all it does is just decrease the hold time. So let's just say we get the spectacular offer at year 3, right? If it makes sense, then our answer is yes, right? We can exit. Investors, make really good returns on that investment. And then we go do the same thing again. So that's just thinking about the idea of selling early. One thing I will say, right, if we do decide to sell early, we did sign a contract with our lender. So we might have to pay a prepayment penalty. But I will say this, right? If we're paying that prepayment penalty, it means the deal was still worth it. And everybody's still doing well. So that's something to think about and to keep in mind. What are my funding options and how does a self-directed IRA work? We talked about that a little bit, but you have multiple options. So initially, right, in the quick presentation, I talked about cash or self-directed IRA, but really you can do cash. You can invest with an LLC. We have investors who've actually invested with a trust, so that is possible. And then you can invest with your self-directed IRA. And Honestly, self-directed IRA in very simple terms, it just means that like your retirement account is what invests directly into the deal. So you don't invest in it, but your retirement account invests. And the benefit to that is that your returns are growing tax deferred. So that's just the big thing about using your self-directed IRA. But again, I said it earlier, the funds have to flow through a custodian. And so we have custodians that we have vetted, that we work with, and that are easy to work with our investors. So if you are thinking about using a self-directed IRA, or using your old 401k or an investment retirement account, feel free to reach out to us and we'll connect you with our custodian and we'll guide you through the whole process. You don't have to, you just have to sign some documents and fill out some forms, but we make it as easy and as seamless as possible. Uh, the next question is, oh, can we visit the property? Yes. The answer is 100% yes. I expect you to come. I would hope you would come visit the property because it is your investment. It is your property. We are all owners of it together. But it is an operating community. That means like people live there. So reach out to me, reach out to someone on the team, and we will schedule a walkthrough. And if I happen to be around, I'd love to do it with you. And we have times where we have kind of events that we put on where we bring our investors. We welcome all our investors to come to the property and to take a look at it. We do tours. You check out the units. We kind of show you what we've done, how the property is doing. We come in the beginning, in the middle, kind of just whenever. So if you are interested in visiting the property, the answer is a yes. This is asked a lot, like what does 6% preferred return mean? And it just means that like investors, you will receive 6% annually before we split the profits. And so that's what you're getting when I would talk about cash flow on the front end. That's what you're getting is that 6% if you're a Class B investor. Now, if cash flow doesn't fully cover the 6% in a year, so like for instance, right, in the first year, where we do a lot of renovations, right? A lot of our capital is infused into renovating the property so that we can, quickly appreciate the value by increasing rent, right? So if we don't give you the 6% year one, that is okay. Your money accrues. And so that is something that I owe you. That is something we owe you, and you will get it. So it's going to get paid later on, but it is going to get paid. So it accrues over time. So if you don't get all of it year one, you will still get it. And I want you to know this, and this is something you have to ask the operators that you're investing with if you don't invest with Pheenyx, right? As operators, we do not get paid. We don't get paid that promote until investors get paid first. And I think this is so important because it aligns with you, right? I want you to make money. And in order for us to win, right, you have to win first. And that's very important. I should not get paid before you get your preferred return. That is very important, at least to us. How would this deal perform in a recession or 20% vacancy spike? So we stress test the deal and we use multiple scenarios to stress test the deal. We even have a break-even occupancy, right? But we increase vacancy, so and that's a way to stress test what happens to the deal if vacancy is at 10, 15, 20%, right? We stress test the deal with slower rent growth. So what happens if rent growth drops to zero, if it becomes negative, if it drops by 1% or 2, that is another way to stress test the deal. We sometimes even will like flat appreciation and see what happens to the deal. Like, will it still perform? And so that is some of the ways that we stress test a deal. Even in stress scenarios, right? Stress cases, right? The property still produces income. And that's the big thing, right? You want to invest in a property that is cash flowing from day one and that continues to cash flow. Now, your returns might be compressed, right? So maybe if the deal was supposed to do 17%, it ends up doing 15%. But I think the most important thing, and I want you to hear this from me, is that with every power in me, your principal is protected. That is my number one priority. And so even in stress cases, right, we want to make sure that the principal of our investors, that means that your initial commitment is protected. I would say this, right? We avoid those razor thin deals. You know, those deals that like as soon as something negatively impacts the deal struggles and potentially fails. that is not a good deal. That is a deal that we will very quickly walk away from. And you can tell that very quickly if you stress test a deal. If you put one scenario in and you maybe increase vacancy or you decrease rent growth or you put a higher exit cap rate, as soon as you do any of those things and the deal fails, you probably should walk away even before you think about putting in an offer on the deal. And the next question is, what specific downside protections are in place to preserve investor capital? So that's very important. And I will say, I've said it before, I'll say it again, like conservative underwriting is very important, is one of the things that we focus on in the beginning, right? When we start underwriting the deal, is the is just to make sure that we are conservative in our numbers, in our projections, in our assumptions. I think that it's better for me to kind of come to you with a deal that I think will do better in the long run. And I think that's fair. So I want to under promise and over deliver. I think that is like the best case scenario and the biggest win for everyone. So the downside protections, right? We talked about stress testing. One of the big ones that sometimes I don't mention as much is fixed debt. But that fixed debt is so important, especially in the kind of interest rate market that we've seen in the last few years, where interest rates went from 2, 3% to like 7, 8%, right? A lot of the deals that were saved were because we had fixed debt. So that's something that's very important. And then like strong reserves. So making sure that you have reserves for a rainy day is so important. Another thing is like property management team, an experienced team is so important. A team like I've learned and we have learned that we don't necessarily want the largest team, right? We want a team that is a decent size, that has experience, that has years, but that can also focus on our deals. That is very, very important when we think about like the type of team that we want as we acquire more deals, especially as we think about kind of acquiring in a specific area. But real estate is never zero risk, right? If anybody tells you that again, you should go the other way. But these risks are, we can control them. And that's what we do with some of kind of the scenarios that I've put in front of you. Have you experienced underperformance before? Yes. So we have one deal that occupancy dropped more than we expected, and we had to pause distributions with the goal of like building occupancy back, right? And I want to say that because I have learned that our investors want more than anything transparency, and that transparency leads to trust. And so, even when we paused distributions, investors stood by us, and it was for a short period of time. But I'll say this again, right? Real estate is not perfect, but when challenges come, right? Our biggest focus, and this is something you should look out for, is to focus on operations, right? So improving management, tightening expenses, those things are really important. And then above all is communicating openly with investors. So let them know, we send monthly updates to our investors. And the goal of that is to really know what's going on, with your investment, what's going on with the property, how is the property doing from a financial standpoint, from a capital expenditure standpoint, from a resident engagement standpoint, right? Like, how is the property doing? That's very important. And so our goal, again, right, is to communicate transparently and above all to protect your capital. So deals don't always go well, but like every step of the way is to let you know this is where we are and this is what we're doing to rectify the situation. Why invest in this instead of another asset class? And a lot of investors have asked me, like, what's the benefit to this versus something else, i.e., the stock market? I get that a lot. And I do believe in diversification, so I think you should do both. But I would say that real estate, it offers things that we've talked about. So, like, it offers cash flow. There's tons of tax advantages that you can take care of, that you can take advantage of. I talked about depreciation, this 1031 exchange, and it truly is a hedge against inflation, investing in real estate. But I think some of the things that we don't even think about as to kind of why what real estate offers as opposed to a different asset class is just like it's a tangible asset, right? Housing is truly a basic human need, and we are filling that need. And so it's always going to be needed. So think about adding that to your diversification strategy. And then, real estate also offers forced appreciation. So like we do things to force appreciate the value of the property that's going to help grow the NOI. And at the end of the day, it's improving returns to you, our investors. So those are kind of just some of the reasons why you should think about investing in real estate, right? And unlike like stocks, right, we actually can influence the performance of the property through operations. So what we do, what we continually do on the property actually does matter. What is the projected distribution schedule? This is probably the first question that I get. A plan is quarterly distributions, and we start distributing one full quarter after like financial operations after closing. So let's just say Park at Arlington closes March, right? Let's say March 2nd. A full quarter is the end of March. And so the quarter closes end of March, but that is not a full financial quarter. So it's after the end of the next quarter. So one full quarter of financial operations. So you'll get your distributions. You will still get distributions from that, like let's just say March 1st to March 31st. You'll still get something, but you won't get it until end of second quarter. So that just makes sense. Um, so yes, so I think those are all the questions that we got asked or that I get asked. I get asked a lot, but I think those are the questions that I felt were really important for our investors that they would like to hear or I just thought was important. So if there are any additional questions, I'm going to, in a second, I'll stop sharing and kind of look at it. But I think that pretty much covered a lot of questions that people are thinking of that might make them nervous. I made sure that I picked the maybe toughest questions that I get from my investors because if they are thinking it, you are probably thinking it as well. And I wanted to be able to answer that. Some of the easier questions, you'll find them on the deal deck. You'll find them in like maybe we've asked it in one of our previous webinars or if you get on a call with me. But these are some of the questions that I just felt like were really important to help you get a full understanding of what it means to invest in an opportunity like this. So again, right, the link to the portal will be in the chat. I just want to say thank you again for spending the time with us. I'm always forever grateful to have the opportunity to share about this great asset class. And I'm grateful to the investors who have invested with us in the past. I'm excited that you're partnering with us on the Park at Arlington. And for our repeat investors, really, I just want to say thank you. And then the new ones who are thinking about it, we welcome you. We're excited to have you in our community. And I know that this is just the beginning to a really fruitful relationship. So yes, if you want to connect, this is my information, and I am going to stop sharing. Um, Perfect. Okay, so I don't see any additional questions in the chat. I'm going to give everybody a second. There any other questions? And again, thank you so much for your time. And I'm going to wrap up. This recording will be sent out within the next 24 hours.